All right, let's dive into a financial metric that, I know, sounds a little complicated, but it actually tells a surprisingly powerful story about how a business really works under the hood.
You see a term like capital intensity ratio, and your eyes probably start to glaze over. You're thinking, great, another piece of confusing jargon from the finance nerds. But what if this one number is actually a key that unlocks a company's entire strategy? So, we're going to strip away all that complexity and show you exactly why this single number is so revealing about the very engine that makes a company go. At its heart, the capital intensity ratio answers one simple, incredibly powerful question about any business. It gets right to the point. How much stuff, how much capital does it take to make just one single dollar in sales? Okay, so that's the official, textbook definition. It's all about measuring how efficiently a company uses its assets, things like its factories, machinery, and all its property, to actually make money. So here's the simple rule of thumb, the main thing to remember. Lower is better. A low ratio means a company is lean, it's efficient, and it can make money without needing a ton of expensive stuff to get the job done.
So let's see how this ratio actually plays out in the real world. Because the key here is all about context, right? You can't compare a tech startup to a railroad and expect the numbers to mean the same thing.
And you can see a really clear divide here, can't you? On one side, you've got the heavy hitters, industries that need these massive upfront investments in physical things like factories, oil rigs, and airplanes. And on the other side, you have these asset-light businesses built more on people, ideas, and software.
So how do you actually calculate this thing? Enough with the theory, let's just run the numbers with a quick example.
And you know what? The formula itself is wonderfully straightforward. You just take a company's total assets right off its balance sheet and you divide that number by its total revenue for the same period. That's it. Simple. Okay, so imagine we have two direct competitors, both in the exact same industry. This is where the ratio becomes an incredibly powerful tool for comparison because it helps you see who's actually operating more efficiently. First up, we've got Cola Drinko. We run the numbers and their ratio is 1.4. So what does that mean? It means for every single dollar of soda they sell, they need $1.40 in assets backing it all up. Now let's look at their competitor, Cola Bubbles. Their ratio is much higher. It's 2.5. They need a full $2.50 in assets just to generate that same single dollar of revenue. So the verdict here is pretty clear. With that lower ratio, Cola Drinko is just getting way more bang for its buck. It's generating revenue much more efficiently from its asset base than its competitor is. Now, you may have heard of a similar metric called the asset turnover ratio. And if you look at the formulas side by side, you probably notice they look like they're the same components, just flipped upside down. And that's because they are. They're two sides of the exact same coin. They're mathematical reciprocals. One tells you the assets you need for every dollar of revenue. The other tells you the revenue you get from every dollar of assets. They measure the same fundamental thing, just from opposite angles. But, and this is a really big but, like any single financial metric, the capital intensity ratio has its limits. It can be super misleading if you don't know what to watch out for.
You've got to remember that this ratio is just a snapshot in time. It's based on past data, so it doesn't account for stuff like inflation, which can make old assets look artificially cheap. It also totally misses all those intangible but vital factors, like a powerful brand, or brilliant leadership, or happy employees.
But this brings us to a really fascinating twist. I mean, we've been saying this whole time that lower is better, right? But what if a high capital intensity isn't a weakness? What if it's actually a company's greatest strength? This quote just perfectly captures the strategic side of this whole thing. That huge cost can be a heavy weight to carry, or it can be a fortress wall. I mean, think about it. The massive, absolutely eye-watering upfront cost to build a new car factory, or an oil refinery, or a national cell phone network. It makes it incredibly difficult for new players to just jump into the market. It protects the established companies and can give them some serious pricing power. So this leaves us with a final, really crucial question. It forces us to stop asking only what a company earns and to start asking, what does it cost to earn it? Understanding that difference, well, that's everything.